Good morning. My name is Neil Kashkari. I'm president of the Federal Reserve Bank of Minneapolis. This is my son, Tecumseh. He's home on a daycare today, so he's with me in the office. I hope you'll understand, and hopefully it won't be too big of a distraction. Our next conference should be on childcare and the economy. Maybe we'll follow up with that. I want to thank my colleagues at the Dallas Fed who have a tremendous amount of expertise in the energy sector. We obviously have the Bakken in our region. Dallas has the whole Texas energy complex. And it's great to work with them on this important event. You know, we're here because inflation is much too high. And what causes inflation to be too high? Well, it's an imbalance between supply and demand. And when demand exceeds supply, prices go up. And energy is obviously a very important piece of this. The energy sector is a big sector of the economy, but it also feeds into all other sectors of the economy. So how do we bring inflation down? Well, there are two ways to address it. One is to increase supply, and the other is to reduce demand. As many people have noted at the Federal Reserve, we don't really have the ability to increase supply ourselves, but we can do something about demand. And the question that I have, and many of my colleagues have, is how much are we going to have to do? And so today, we have convened experts to try to get an outlook for the energy supply in the near term. And we want to ask questions. What are energy experts looking at? What do they think is going to happen in terms of energy supply and energy prices? And what can the industry do to increase supply in the near and medium term? And then importantly, what can policymakers do to help? This will directly inform our assessment of the supply potential of the economy, and therefore, by extension, how much we will then have to do with monetary policy to bring demand into equilibrium with supply. I'm confident that my colleagues and I have the conviction to do what we need to do to bring inflation back down. But I'll be honest with you, I hope we have to do less. And we'll only be able to do less if more supply comes online. So we've convened experts from industry and government to have this discussion and explore these important issues. Following our open discussion of the economy and current geopolitical dynamics, we've got industry experts and then a conversation with Senators Kramer from North Dakota and Hickenlooper from Colorado. The panels are going to be moderated by Mike McKee, the international economics and policy correspondent at Bloomberg News. We have a tight schedule, so we're going to move right into the program. I'm pleased to introduce my colleague at the Dallas Fed, Lutz Killian, Senior Economic Policy Advisor. He's one of the world's leading experts on applied econometrics and energy markets, and has served as an advisor to the International Monetary Fund, the European Central Bank, the European Commission, the European Parliament, and the Board of Governors of the Federal Reserve System. Prior to coming to the Fed, he had his distinguished academic career. Following Lutz's discussion of energy and inflation, I sit down with Jason Bordoff to discuss geopolitics. Jason is the dean of the Columbia University Climate School and is one of the world's leading experts on energy and climate. Because today's commencement is at Columbia, Dean Bordoff could not be with us live, so he and I taped our conversation earlier in the week. With that, we are very pleased to be with you this morning, and we turn it over to Lutz.
Good morning, everybody. The first slide here shows the evolution of the 12-month headline CPI inflation rate from the early 1960s to today. What you immediately notice is that there were two big surges in inflation in the 1970s and early 1980s. What you also notice is that to the far right, there is something that looks like a potentially similar surge in inflation most recently. A natural question is whether that recent surge was perhaps caused similarly to the earlier peaks in the 1970s and early 1980s. If you were to open a standard undergraduate macro textbook, they would probably tell you that the inflation spikes in the 1970s were caused by oil price shocks. That's actually no longer state of the art in the literature. So let me start giving you a rundown of what we've learned over the last 20 years or so. The first is that US inflation was well on its way in the 1970s before the oil price shocks. If you look at the data, most of the increase in inflation in the early 1970s had happened already by the time that we saw the first major oil price shock. And that means that much of this inflation had little to do with oil prices. So where did this inflation come from? It was driven by shifts in fiscal policy in the late 1960s and by shifts in monetary policy starting in the early 1970s, as policymakers faced an uncertain economic environment and focused on the employment objective. We saw similarly expansionary monetary policies worldwide, which pushed up global industrial commodity prices, including oil prices, both directly via the US inflation and dollar depreciation, and indirectly by stimulating global real activity and hence the demand for oil and other commodities. It turns out that oil price increases caused by oil supply shocks, as opposed to oil demand shocks, historically has never caused persistent inflation. An unexpected increase in oil prices, all else equal, causes a one-time blip in the inflation rate. That point is very important because it says that it takes repeated oil price shocks to generate persistent changes in the price level. Moreover, there is no evidence for large, persistent secondary effects of oil price shocks on US inflation in the 1970s, or for that matter, since then. Now, that may sound at odds with the common notion of a wage price spiral caused by oil price shocks, and indeed, the evidence for such wage price spirals is extremely tenuous. Such spirals are implausible in the United States, given the lack of strong unions that would push up nominal wages. And in fact, when you look at the data, US real wages historically have declined in response to real oil price shocks rather than having remained constant. And finally, there has been a healthy debate about whether changes in the monetary policy reaction function over time might explain the changes in the responses of inflation to oil price shocks over time. And the short answer to the question is no, that is not what was going on. So with this in mind, let's look at the most recent evolution of oil prices. Starting in early 22, what you see is a steady increase in the oil price even before the invasion of Ukraine. That reflected sluggish increases in global oil production and robust demand for oil. Then in late February, we saw the invasion of Ukraine. You saw a spike in the oil price. Then the oil price came back down and has been going up and down basically ever since, including if you extend the sample to early May, reflecting great uncertainty in the market about the fundamentals. So what do oil price fluctuations do to consumer prices? The first point we need to keep in mind is that consumers do not ever buy crude oil, they buy refined products, such as, most importantly, motor fuel. Motor fuel accounts for about 3% of consumer expenditures. That is modestly large, not as large as some other components. We also have to keep in mind that a given increase in the oil price, say by 10%, does not mean a 10% increase in gas prices, given the about 60% cost share of crude oil in the retail price of gasoline. It will typically translate to about half or 60% of that. So a 10% oil price increase would be only a 6% increase in retail gasoline prices. If you look at structural econometric models, you can quantify the impact of a 1 standard deviation gasoline price shock on inflation measures. You will see that headline CPI inflation will jump on impact. It will stay high for about 2 months, and then it will be back to something that is basically indistinguishable from zero. If you take out the food and energy component, in particular the energy component, you see that the core CPI inflation rate really doesn't respond very much. It's not really distinguishable from zero and quite small. If you look at household survey inflation expectations, if you're looking at 1 year short run expectations, they respond quite a bit. 5-year expectations, much less so. And in general, there is no evidence that gasoline price shocks are moving long run inflation expectations. Of course, in real life, we typically don't see one gasoline price shock in a given month in isolation. We see sequences of gasoline price shocks, and we can use a structural econometric model to trace out how much these gasoline price shocks have contributed historically to inflation. We can also look into the future, and I'm going to do that by postulating a particular scenario where we have data up to March of 22 for all the inflation measures. And we then postulate that the oil price measured here by the WTI price of crude oil drops to $102 a barrel in April. That's actually observable in the data, and then returns to $110 in May and stays there until December of 2023. Given this scenario, I can take the percent growth in the oil price, map this into the percent growth in the retail gasoline price, and then use the structural model to back out the underlying structural shocks required to make this happen. I can then turn around and saying, how does this shock sequence affect monthly headline CPI inflation? Now, what you see in this picture is a vertical blue line. That's March of 22. Everything to the left of that is what happened historically, starting roughly with the period of the COVID recession. Everything to the right of that, that's what's happening under this scenario. And what you see is that we had a big spike in the impact of gasoline price shocks cumulatively on monthly headline CPI inflation in March. But the model predicts that in April, will come down to about 0 under the scenario. Then for the rest of 22, we'll be at about 2 percentage points at annualized rates, and then we're gradually going to come down in 23. Now, most people would focus not on the 1-month inflation or month-by-month inflation rate, but on 12-month inflation rates or year-over-year rates. This is shown in this picture here, which has results for headline CPI, headlines PCE, and the corresponding core rates. What you see is that in early 2020, when the COVID recession hit, we saw a big decline in inflation rates associated with a decline in gas prices as people cut back on their driving and the economy slowed down. This started changing in about May of 2020. We've been going up ever since. Of course, a lot of that increase was just making up for earlier declines. By March 22, we were a little bit over 1 percentage points for the contribution of gasoline price shocks to 12-month inflation. Interestingly, according to the scenario, if we go into the future, a 12-month inflation will only peak in early 23, and that's because it is constructed by looking at an average of all the inflation rates that happened over the previous 12 months. If you look not at headline CPI, but at headline PCE, that's the dashed red line, you see a somewhat smaller increase. And if you look at core measures of inflation, we're going to go up to about half a percentage point by the end of 23. Now, you may have noticed that in my scenario, I didn't say anything about the possible EU petroleum embargo, and that's for a good reason. We don't know how that will work. We don't know what the effect on the price is at this point. But let me talk a bit more about what's been happening in Ukraine and how that has affected oil markets. Russian crude oil production is a total of about 11 million barrels a day if you include products. 5 million of that is crude exports to the rest of the world. Another 3 million barrels is product exports, oil that is being refined in Russia and then being exported, and the rest is being used domestically. What happened in Europe is a lot of self-sanctioning following the invasion. Some countries, Canada, the United States, and to a lesser extent the UK, instituted petroleum embargoes. Of course, in many cases, that meant they weren't importing much Russian petroleum in the first place. And for the rest of the world, for the most part, they were not imposing sanctions, have not been imposing sanctions, and have taken a fairly cautionary approach, not increasing their imports from Russia a lot, with the exception of India. What's interesting about this is that this is really a negative shock to the demand for Russian oil. It is not a Russian oil supply shock because Russia is quite happy to supply. How has this affected Russia? Well, if you look at the data for April, Russian seaborne crude oil exports actually have remained quite robust. And there has been a decline in the exports of products, diesel and other products. There has also been a decline in domestic demand for fuel in Russia. Just think of all the Russian planes that are no longer flying. That has forced some Russian refiners to cut their production runs because they were running out of storage capacity for the diesel, gasoline, and jet fuel they are producing. And that in turn has forced some Russian oil producers to stop pumping oil. We estimate that the reduction might be in the neighborhood of about 8% of Russian production. That sounds like a lot, but keep in mind that when you have a decline in Russian demand and a decline in Russian supply, that cancels. So from the point of view of global markets, the change is probably only about half as much, the shortfall. Russia no longer reports oil production data. They stopped doing that. We know that perhaps 3 million barrels a day of Russian petroleum exports to the OECD are at risk of being shut in by the end of 22 if there is an EU petroleum embargo. Why is that significant? Well, if that were to happen, then once that production has to be shut in, it becomes very difficult for Russia to restart production, especially without foreign technical assistance. So we could be looking at an extended period of lower Russian oil production once that happens. So that leads me to conclude that we've only seen the beginning of this oil supply shock in all likelihood. Not much has been happening so far when it comes to oil supply and oil prices. That's why you haven't seen bigger increases in oil prices in particular. Given inelastic oil production elsewhere, including in OPEC, and given inelastic gasoline demand, at least in the short run, it will take a substantial oil price increase to bring down oil consumption to match available production. That is, unless some combination of the following three things happen. First, the global economy slows down for other unrelated reasons. And a good example here would be strict COVID-19 policies in China. Second, the oil deliveries that used to go to Europe are redirected to Asia. That really hasn't happened so far. And third, sanctions are being circumvented in the gray or black oil market. Given all these qualifications and uncertainties, it's very hard to tell where the price of oil is going to go. If you read the press, you'll see predictions of $150, $200, $300. It's important to understand that these are merely conjectures, and conjectures that tend to reflect the vested interest of the person making those conjectures. The truth is, no one knows. Now, as a benchmark, the peak price in June 2008 in today's dollars was 184, and so we're still a long way from such a price. Let me conclude by pointing out why this particular oil supply shock, if it were to happen, would likely to be more severe than some other oil supply shocks we've seen in the past. The reason is that this isn't just about oil, but it's also about natural gas, in particular in Europe, and that is likely to be propagated to the rest of the world through LNG trade. It's about other industrial and food commodities that affect the global economy, and it is about global supply chain disruptions on top of the supply chain disruptions we've already seen. So there is every reason to worry about the inflationary impact of the invasion of Ukraine in the medium to longer term. Thank you.
Now my pleasure to welcome Jason Bordoff to our conference. Jason is an expert both in national security, in energy policy, and in climate policy, and the intersection of those. So he's a great expert for us to lead off with in this early conversation. Just right now, Jason is co-founding dean of the Columbia Climate School, founding director of Center on Global Energy Policy, and professor of professional practice in international public affairs at Columbia University, and has served in the White House in senior national security roles related to energy. And so, Jason, thank you for being here. Welcome to our conference. At Columbia University.
Thanks, Neil. It's really good to be with you. I appreciate the invitation.
Well, I want to start, the point of this conference, as I mentioned at the introduction, is the Federal Reserve is very focused on inflation. Obviously, that's our primary responsibility, and inflation is much too high, and energy is a big part of that. We want to understand from you and from other experts on what is the outlook in the near to medium term for energy prices, because that's going to be an important input into our analysis of the economy and ultimately where monetary policy goes. But then related to that, what can be done and what will likely be done on the supply side? Because if it's all up to the Federal Reserve to bring demand down across the economy to match supply, to get inflation in check, we're going to have to be much more aggressive with monetary policy. If we get help from the supply side, then we don't have to bring demand down as much, and we're going to have to do less. And so the more the supply side can do, the better. And we have some political leaders later on in the day, a bipartisan basis, who are going to be offering their perspective. So the key for us is where's energy inflation going, and then what can be done by industry or by regulators to try to bring more supply on. So we wanted to start here with you today, because the intersection between energy, inflation, geopolitics, climate change, these are very complicated issues, very complicated relationships. And so as I think about it, in the context of the last decade or two, we've been trying gradually to move to a clean energy future, focusing on climate sustainability. In the near to medium term, that's one of higher costs, because the technology does not yet exist for alternatives that are cleaner and cheaper. So that's a pressure pushing prices up.
Yeah.
Now, of course, we have the tragedy of Russia invading Ukraine. It's a human tragedy, but also has profound implications on the global economy. That also is leading to higher prices. And now we're reopening the economy after COVID shutdown. So there's a lot going on there. And I'm just wondering if you can start thinking about your geopolitical lens, your national security lens, and your energy policy lens. Where do you think we are, and what's the outlook from here?
Yeah, so much to say about those really important questions. So let me say a couple of words, and then we can go deeper on whichever aspects you find most helpful. And it is it is such a shift to be having this conversation relative to the conversation we've been having for the last 10 or 15 years, which was one of an era of abundance and affordability. And we had sort of a collective amnesia that energy security remained a real risk, driven in part, I think, by the shale revolution and the fact that the US went from importing 2/3 of its oil to being a net exporter last year. We had abundant oil, abundant gas, and that helped meet the increase in global demand as well as our domestic demand. Suddenly, energy security is front and center again, the national security risks, the geopolitics of energy, along with the urgency of addressing climate change, which I think may be slightly in the back of people's minds relative to meeting today's energy needs, but it's certainly not going anywhere. That urgency is only going to increase moving forward. And I think, let me answer your question in two respects. One is oil and gas, and then the other is clean energy, because there may be what would be, from inflationary standpoint, concerns on both. So with oil and gas, obviously we have pretty high oil prices now, over $100 a barrel. Natural gas prices are at eye-popping levels, not as high as they were, but roughly $30 or so in Europe and Asia, even $8 or $9 here in the United States, which is pretty high, the highest since 2008. Russia has a lot to do with that, but we should remember we were risking energy security challenges and a modest energy crisis even before Russia invaded Ukraine. Europe barely made it through last winter, only with the help of sort of warm weather. There are a variety of reasons for that. But if you look at the amount over the last 2 years that's been invested in the oil and gas sector, it is below what is needed to meet current demand for oil and gas. It was a level that was roughly consistent with what the International Energy Agency tells us we should be investing in oil and gas if we were on a pathway to achieve our climate goals of net zero by 2050. The problem is we're not on track to meet those goals by any means. We are way off track from those goals. And a combination of factors, including poor economic returns in the industry, plus increasing social pressures for financial institutions to pull back from investing in oil and gas, created a risk of underinvestment relative to what the reality of today's demand is. And so we were starting to see prices go up already. We should remember President Biden released the SPR not only in response to the immediate crisis, but last November as well. We saw utilities across Europe going bankrupt and governments stepping in to subsidize energy costs even before Russia invaded Ukraine. Partly that was driven by Russia's curtailment of gas supplies to Europe before the invasion. So you can't act from a supply and investment standpoint like you're on track for your climate goals if you're not actually on track for your climate goals. And I think there was a risk that people saw that might be starting to happen before this crisis. Then you try to take Russia off the table, try to curtail your consumption of Russian oil, Russian gas in order to apply maximum economic pressure to Russia. That is obviously very painful, most painful for natural gas, which is for European consumers like Germany. But as the horrific images we see coming out of Ukraine continue to get worse and worse, I think the pressure is only going to escalate. It started with the US banning the import of Russian crude, and then the UK. Now all of Europe has said they're going to do that. They haven't yet done it to refined petroleum products. The diesel market is kind of in crisis right now. But if these images continue and Russia's horrific abuse continues, I think the pressure will grow and eventually to natural gas too. So now you need to meet oil and gas demand globally while hopefully taking Russian energy off the table to apply maximum pressure to Putin. And there's just not enough extra supply out there to replace that. Some of it can come from efficiency. You can dial down the thermostat a few degrees or use energy more efficiently in other ways, find some alternative low carbon supplies, but those take years to come online. They don't happen quickly. There's a little bit of extra oil that Saudi Arabian UAE could put on the market. Maybe if there's an Iran deal, we'll get some extra supply, but there's not that much extra supply in a pretty tight market. So all of that I think is somewhat bullish. We've also had this demand hit as a result of the zero COVID policy in China that's taken 1 to 2 million barrels a day of oil demand off the table. When that opens back up, that's also going to push oil prices up as Chinese demand soars back. On the other side, as you said, we are trying to accelerate a transition to clean energy. We're not moving nearly as fast as we should, which is why oil, gas, and even coal use are still increasing right now. And as we move faster to do that, and hopefully what's happening with Russia and Ukraine will be a reminder that we would all be more energy secure if in fact we were less dependent on globally traded hydrocarbons that are inevitably exposed to geopolitical risk. If it's not Russia, it'll be something else. We've obviously seen that over the decades dating back to the Arab oil embargo and even before. But if you try to ramp up clean energy much faster than we are today, which we should because of the urgency of climate change, you have constraints with supply chains, with critical minerals, a host of other things that, as you said, will put upward pressure on price. And that's what we have seen. We were used to sort of solar costs and battery costs just falling year after year after year. And then the last 2 years, we've started to see those costs rise again. And I think the faster you do that, it's going to take time for markets to respond and for the supply chains to catch up. And the mining, we have to do a lot of mining if you want to have a clean energy transition. It takes a long time for that to come online.
So, boy, there's a lot there. Let me just ask a few questions that jump at mind. One is just focusing on Russia for a second. As I'm going to oversimplify it, but the oil market is a global market. And even if the West is effective in saying we're going to wean ourselves from Russian oil and gas, if Russia then just sells it to other countries that are sympathetic, I guess that won't have much effect on price. Will it have any benefit for national security? I'm just curious.
Yeah,
maybe it's not that easy for them to shift who their customers are.
Some of it is, some of it isn't. They export around 3 or 3.5 million barrels to Europe, around 1.5 by pipeline. Pipeline exports are a little more difficult to reorient to send to other markets. Some of it can be moved to ports. There's a limited amount of port capacity. There's a limited amount of tanker capacity. So there are different estimates out there for how much, if Europe says we're not buying Russian crude anymore, maybe 1 to 2 million barrels of that will be redirected. Some of it will be lost to the market. To the extent they do redirect it, and we're already seeing that now, even before Europe banned Russian crude, there was the so-called self-sanctioning, where lots of buyers of Russian crude were choosing not to buy it, not because it violated sanctions, but because of the reputational risk doing business with Russia right now for energy companies and lots of other companies. Russia is taking a lot of those barrels and selling them elsewhere in the global market, to China, to India, other places, and selling it at a steep discount. I had the European Union Energy Commissioner at Columbia a week or two ago and was interviewing her on stage, and she explained that dynamic. And I sort of said, well, is your strategy then that actually that's what you want to happen? If Europe bans the import of Russian crude, most of it will find another way to get to the global market because the market needs it right now and you're worried about higher fuel prices for people, but you will force Russia to take a 30-40% discount on every barrel. Maybe that's the best of both worlds. We get the oil supply to help with consumer prices, but you put a big dent in Russia's revenue. And she said, yes, that's part of the thinking and the strategy. So I think you'll lose some Russian supply, a lot will be redirected, but it might cause Russia to take a bigger hit to its revenue than would be the case if you didn't put that ban in place.
Interesting. I never thought about or heard about the discount. That makes sense. And of course, it's complicated because the more you're effective in cutting Russia off from supplying the world market, the higher oil prices will therefore be. So the barrels that they do sell, they're going to make higher profits on those barrels. So it's a complicated equation of how it actually passes through to Russian revenue, but also to prices around the global economy. So is there anything that you can think of that domestic policymakers in the United States could do, for example, to try to alleviate some of the near-term price pressures on oil and gas? It's certainly about driving people's cars and trucks. It's also about heating people's homes. Obviously, we're going into summer, so air conditioning in the south is going to be important, and then winter up here in the north, heating homes is going to be very important. Anything that you're aware of that policymakers could do to make a dent here?
The options are limited, and that's the case whenever we have an oil crisis and an oil price spike. Politicians scramble to see what we can do in the immediate term, what can help right now. And the truth is, most things take a little bit of time or a lot of time. There's not a lot you can do right now. And then we sort of forget to stay the course and do the things that take longer, but would make us more resilient and more secure the next time there's an energy supply crisis, which inevitably there will be, whatever it is next time. Nonetheless, there are some things you can do today, and we've seen some of those actions being taken. The United States and Europe used the strategic oil stocks that were created after the Arab oil embargo and put a huge amount of, the largest release in history into the market to help provide some certainty that alternative supplies will be there. I think it is important to think about the most vulnerable households, and so I don't think government should just wholesale subsidize energy prices across the board, but we do need to think about the regressive and distributional impacts of high energy prices. And so I think targeted relief to the lowest income households in whatever form that takes from government would make sense. And then there are sources of near-term supply. It would be good if we had a deal, a nuclear deal with Iran, both because that would hopefully, if it was a good deal, prevent Iran from acquiring a nuclear weapon. That would also mean more supply comes to the market. The Biden administration, I think, is working for sort of a reset in relations between the US and the Gulf Arab states. And there are a lot of benefits to that beyond energy, but the likelihood that OPEC would ramp up its output a bit faster may be one of those. And then domestic supply. Obviously, the US shale is short cycle supply. It responds very quickly to changes in price, and it is going to respond. We're going to see growth of more than 1 million barrels a day in US oil supply this year. On the margin, I think there are things that the administration, that government could do. There are some near-term permits on existing leases or some additional infrastructure like pipelines that would, not in the very long term, you're thinking 5-10 years out, but in the next couple of years, help additional supply come to market. Part of that is not just government, part of that is the financial community, where I think because there was so much money lost in shale over the last decade, a lot of CEOs feel like if they announce they're going to grow oil production much more quickly, they'll be penalized rather than rewarded in their share price. So the question is whether that capital discipline will shift as well in the financial community.
Well, those are a lot of content there for me to digest. Let me just stay on that last point, because I've heard this a lot from, in our district in Minneapolis. We're proud to partner with the Dallas Fed. We have the Bakken up here. They, of course, have all of Texas. You have the Permian Basin, for example. And I hear this a lot from oil executives in my region that, hey, Wall Street is saying, we don't want you growing, we don't want you growing. So when I think about that, if there's money to be made, usually Wall Street wants to go and make the money. And so I guess my interpretation is it a lack of confidence that these high prices are going to stay high, and that, hey, we're going to make this big investment, and then 2 years from now, prices are going to fall and we're going to lose money again? Is that fundamentally what's going on?
Yeah, it's a good question. And I think that so-called capital discipline is going to ease because, as you said, there's just too much money to make at these oil prices. There are constraints on how quickly you can grow production separate from the financial community or government, just the supply chains, the amount of rigs you can get, the water you need, the sand you need, the workers you need. So there are some constraints. I do think there's a concern about kind of overexuberance again, and maybe chasing after too much growth relative to what's economic. And I do think there's some concern about the time frame here. This is especially for a Democrat administration that's deeply focused, as it should be, I'm glad it is, on the urgency of the threat of climate change. We need supply today to keep energy affordable and secure for people, and we want a different kind of energy system in the future. So I think policymakers are often looking to thread a needle between the things you can do today that help to increase supply, or not just today, but in the near to medium term, but don't make it harder to get to your climate goals longer term. So governments, like the European governments, Germany just said they're going to build 4 new LNG import terminals. And they simultaneously said, we're going to pull forward the date by which we want to decarbonize the electricity sector. So you're asking the private sector to spend huge amounts of capital to increase supply. And usually these projects take a couple of years to come online. At the same time that you're saying we are going to double down on our goals to not need nearly as much hydrocarbons in 10, 15 years as we do today. So you got to make sure these projects pay for themselves over time. And I think uncertainty about the outlook for oil demand because of the increasing urgency of dealing with climate change presents part of that. It's part of the challenge you were describing with how comfortable people feel about putting lots of capital into oil and gas. What's interesting is that shale is kind of well suited for that challenge because it is short cycle. It is near term. You put a lot of rigs to work today, you put capital to work today, you get most of the supply in the near term. If we have an energy transition happen more quickly than some expect, and oil demand does in fact start to fall sooner than some think, you stop operating the shale rigs and production falls pretty quickly. So it's sort of well designed for the uncertainty about how quickly the transition might play out.
You know, you've given me so much to think about, and we only have a few minutes left. How do you think about just the context, the arc of continuity? And here's what I mean by that. I think about the Fukushima disaster in Japan. Some countries responded to that and said, we're getting rid of our nuclear. And obviously nuclear energy will be more resilient in the face of the geopolitical pressures if there was more nuclear today. At the same time, think about Venezuela and Iran. You know, I think about, is Russia going to pay a permanent price for this behavior, invading Ukraine? Well, I'm skeptical, because wait till somebody worse comes along and then all of a sudden we're going to re-engage with Russia, just like we're trying to re-engage with Iran and Venezuela. Somebody worse came along and now we're going to re-engage with them. As you think about the arc of years and decades, you know, are there some key decisions we need to be making now to try to position us so we're just in a better place in the future? Sometimes these short-term decisions don't look so good in a few years.
Yeah, it's a really interesting question, and one I was thinking about, and I actually asked the Energy Commission of Europe the same question, which was, we want a lot of investment in alternative sources of oil and gas today to take Russia off the board. We're asking, you know, the US is going to significantly grow the amount of LNG, for example, that it exports. We're already one of the largest in the world, about 12 billion cubic feet a day, and that's going to grow significantly. I think this crisis will allow several additional projects to get over the finish line in terms of their financing. They have the government permits they need. On the view that Europe is going to need a lot of alternative sources of gas besides Russia. And the question is, you roll the clock forward 5 years or 10 years, and unfortunately, memories are short. When we think of past energy crises, we focus on the crisis of the moment and we kind of forget, the same way we became complacent about energy security over the last decade because of the shale revolution. Maybe, and we have no idea what the future will hold. Will Putin still be in power? Will an opposition leader come into the government? And the question is, can you imagine a scenario where 5 or 10 years from now, Europe once again feels comfortable getting, if not 40%, a large amount of gas from Russia? European consumers, will they be comfortable paying a large premium to buy much more expensive gas from other sources traded globally around the world as LNG? Or will they say there's really cheap gas next door? We're comfortable getting that again, and that's what consumers want. If that were to happen, then all the investments we're making now start not to look so good. We could have a glut in the global gas market. I think that's part of the uncertainty that is facing investors now. And you know, the one thing I'll say about that, I think, is we should not lose sight of the fact that while we do what we need to do to meet today's energy needs and deal with the energy security urgency of the moment, we also should use this as a reminder of what I said earlier, which is if energy, I don't know what better reminder we need than the fact that the US was importing 2/3 of its oil 15 years ago, and we were a net exporter last year, and we're still facing pain at the pump and concerns about inflation when something happens halfway around the world in Russia. What better reminder we need that we are more energy secure when we're using less oil, not only when we're producing more or importing less, not to mention the fact that we need a faster transition for climate change. So I think accelerating the pace of deployment of alternatives to oil and gas and diversifying our energy mix, we should be reminded is important both for climate change, but also because it's going to help provide some more resilience to the economy, because history reminds us again and again, there was an oil price spike today, there will be one again in the future. We don't know when, and that's not good for consumers and for overall economic volatility.
Absolutely. Well, Jason, this has been a great discussion. I could ask you questions for another hour. Unfortunately, we don't have another hour. And so I want to thank you on behalf of my colleagues at the Minneapolis Fed and Dallas Federal Reserve Banks. Thank you for sharing your insights and wisdom with us today. It's been a great conversation and a great way to launch this conference. So thank you very much.
Thank you for having me. It's good to be with you. I appreciate it.
Well, good morning, everybody. I'm Michael McKee. I am the Bloomberg International Economics and Policy Correspondent, and I'd like to start by thanking Neil Kashkari and the folks at the Minnesota Fed, Minneapolis Fed, and the Dallas Fed for putting on this conference. The latest polls that I have seen show 70% of Americans say inflation is the biggest problem they face, and the biggest subcomponent of that they worry about are energy prices, particularly, of course, gasoline. So this is a particularly timely conference to hold. Let me introduce our panel here, and then we can get to questions. First, Vicki Hollub. She's the president and CEO of Occidental Petroleum. She's the first woman to lead a major oil company. She's worked for Occidental in Russia and Venezuela, as well as Ecuador and the United States. So she's familiar with some of the actors in today's oil drama. She also was a leader in developing Occidental's Permian Basin holdings, and so she's very familiar with the fracking situation. She is, we can point out, a proud graduate of the University of Alabama and loves Crimson Tide football. Cindy Taylor is president and CEO of Oil States International, a position she's held for 11 years now. Oil States is a global provider of products and services used in the drilling, completion, production, infrastructure for oil and gas on and offshore. She is a proud graduate of Texas A&M, and I might point out that Texas A&M and Alabama are both in the SEC West Football Conference, and this year, many analysts think that Texas A&M will finally break through and beat Alabama and take the Western Conference crown. So if you guys want to argue about that, feel free. Brian Van Abel went to Dartmouth College, so he doesn't have a dog in that fight, but he's executive vice president and chief financial officer of Xcel Energy. And he also, interestingly enough, leads the company's innovation and transformation office. So we'll definitely be asking about that. Xcel, of course, a utility holding company, distributes electricity to 3.7 million customers, natural gas to 2.1 million in 8 states through its 4 regulated utilities, has distribution lines, transmission lines, and natural gas assets, so covers a lot of ground. They also have wind power and wind farms in Colorado, Minnesota, and other states. So I'd like to welcome the panelists all. Inflation, as I mentioned, and oil prices, a real problem in the United States. I was in San Francisco last week, went to the car rental counter, and the guy said, do you want to pay in advance to fill up the gas? And I said, well, I don't know how much I'm going to be driving, so I don't know if I want to pay for a whole tank. He said, it's a bargain from us. It's $6 a gallon. I didn't take that. But I can point out that's California, of course, but today the national average price, according to AAA, is $4.34 a gallon, which is a nominal high record level. Now, economists don't look at nominal numbers. We tend to look at real numbers, and you go back to 2008, it was $5.24 in inflation-adjusted figures. So we've got a ways to go. But Americans tend to look at the money they're paying at the pump. And so they see that number and they are concerned. The latest University of Michigan consumer sentiment survey that came out today, 46% think gas prices will continue to go up in the next 5 years. 20% think they will stay at least at this level. So there is a lot of concern. People don't necessarily understand the oil industry or what's going on. So we're going to ask you guys to explain all of that. the good news this morning was the government reported import prices were flat in April after rising almost 3% in March because oil prices went down. But I don't think that's going to continue. I want to start, therefore, by posing an umbrella question to each of the panelists. We can start with Vicky and go through everybody and ask, what would you tell Americans about where you think it's going to go from here? And you can express it in price per gallon, or you can express it in oil prices, because even though we worry about the price per gallon we pay at the pump, a lot of people talk about it in terms of the price of a barrel of oil. Where do you think we go from here? Is it going to get worse? Is it going to get better? What should people expect?
My expectation is it's going to get worse from a consumer perspective of gasoline, because oil production is still struggling today. And if you go back and you look at where we've been and where we're headed, I think Jason Bordoff covered every point I was going to make. And that is basically, even before the pandemic, we were starting to see pressure from the investment community because of growth and the lack of return on capital to the investors. So that, coupled with what we're seeing today, means that we've underinvested. The pandemic caused, the greatest demand destruction that we've ever seen in the history of the world, and that, along with the fact that that we need to respect the fact that the supply chains have been disrupted for the oil and gas industry in a very significant way. That, coupled with the investor pressure, means that that we're struggling now to meet what demand is. And oil inventories around the world are below the bottom range of the 5-year average. Spare capacity is at its lowest point in decades. And that spare capacity means that the ability of OPEC or anybody else in the world to ramp up production is limited by the infrastructure. So that's very limited. All of that comes together to mean that that we're headed for an environment where we just can't amp up supply very quickly. And as Jason said, we will see incremental production from the U.S. this year, but it's going to be insufficient to meet the demands. And there's nobody else in the world that can do it in a fast way either. So certainly oil is going to continue to stay at a high price. Gasoline prices will stay high as well.
So Cindy, let me turn to you and ask, have you had folks from Occidental, Vicky or any of her colleagues, standing outside your door saying, I want to buy some more stuff to drill some more wells?
We're getting increased demand, no question. The rig count is actually up about 60% year over year in the United States. So I encourage everybody to think we're doing what we can. But my company, I call us the boots on the ground. We've got workers out on the rig site every day, manufacturing facilities. This is shift work, hard work, hourly work. And this is on the heels of decades of sector instability, volatility of crude prices that hits my workers hard. And COVID was like no other. It used to be 1 million to 2 million barrels a day of change in demand or supply, created significant price volatility. This was 20 million barrels a day, 20% of global production, that led to negative crude prices in April of 2020. And so there are real people behind that message that had hours cut. Most 40 to 50% of the workers in this industry in the field were let go in 2020. Now, the government tried stimulus efforts to stabilize that, but this downturn, if you want to call it that, lasted too long. And we've lost, I think, permanently lost a lot of workers that go out to the well site. These are highly technical, highly demanding jobs out there that a lot of the industries today are facing worker retention issues, loss of workers. It is on steroids for us. And so to think that we can go much higher, much quicker, although I think the U.S. is doing yeoman's work right now to recover some of that lost production, it's going to take a while, and workers and supply chain challenges are going to be key to that. I hate to tell the consumers in America that prices only go up. I will say that drilling and completion activity in the U.S. is the quickest to fall, I would remind everybody who doesn't know this industry, we lost about 80% of the rig count at the onset of COVID in about 100 days. I challenge any business to face the loss of 80% of their revenues in 100 days and tell me how you're going to manage through that. Globally, CapEx spending was down about 50%. We are both domestic, we are also global. So we work really hard to deliver affordable, reliable energy every single day. But just like we were the fastest to go down in the US, we'll also be the fastest to recover because the time between investment and first revenue is shorter in the United States, largely because of the success of companies like Oxy that have advanced technology around shale development. And so there is a good message here, but there are a lot of challenges in terms of doing what we do every day.
Brian, it's a little different for you in terms of it's not the per gallon price that you're affected by as much as it is the kilowatt per hour price and the natural gas price. And as Neil said, you got to worry about heating up there in Minneapolis in the winter. So what's ahead for consumers on that side?
No, that's a good question. And we're certainly focused on natural gas, and an increase in the price of natural gas hits our home heating, our natural gas customers much harder than it does on the electric side, just because it's a bigger component of a customer's bill. But it's an interesting time in the industry, and I completely agree with everything Jason said about the industry making the transition faster to a clean energy generation fleet. And accelerating renewables, accelerating solar, accelerating wind. But as we do that, what we're doing when we think about gas, natural gas from the demand side, as we shut down, the industry shuts down the coal plants, we rely more on natural gas because we still need plants to turn on. And what that does is there's a price point where when you had coal plants, natural gas would get to a certain price point and you would turn off your natural gas plants and turn on your coal plants. So we'd have a mechanism to help kind of destroy gas demand. As we go through this transition and we shut down the coal plants, which is absolutely the right thing to do as an industry, and where we're going from the electric utility perspective, is you lose some of that ability to destroy gas demand. And so what we really need to do is accelerate solar build out, accelerate wind build out, the storage build out to really kind of replace some of the capacity that we're losing in the ability to destroy gas demand on the electric generation side. So that's really kind of an interesting dynamic right now. And there's some challenges in the clean energy supply chains that are happening that has really slowed down some of the solar build up here in the next couple of years.
So Cindy, I want to ask, the standard story is that the U.S. fracking industry expanded like mad, fueled by debt, ran into price pressures, and a lot of companies went bankrupt, then just started to merge and consolidate, and we had COVID, and you explained very well what happened during COVID. Does that start to change now that we have seen consolidation and bigger companies, maybe with better balance sheets, are going to be able to restart the process of bringing more oil on? Or are they looking at conditions ahead and saying, maybe we wait for a little while longer?
Well, it depends on the operator, and I'll give you a couple of comments there. I read a Deloitte report the other day that talked about the strong free cash flow generation for the E&P sector. It totaled about $172 billion for 2022. That sounds like a great headline number, but the caveat to that only recovers about 60% of the negative free cash flow that was generated over the last decade. And again, this price volatility makes it very, very challenging. I'll also add that a lot of that ramp in activity was technology-based. It's lowered the cost ultimately to the consumer back in the last 7 years. It hasn't been great for companies like mine that are delivering better technology at a cheaper price if you're on the manufacturing and the service side of the business, but we support our customers. Their cash flows are improving without question, but you got to ask yourself, and I follow my own customers every day, do they have leverage in place? Because they will have obligations to repay the debt that they have unless they did go bankrupt and have restructured balance sheets. So there's dueling competition here. And by the way, a shareholder that invests in this company, real dollars, they want to get that dollar back plus a return, just like any other business. And I go back right now, the E&P sector looks to be doing very well, but you got a lot of ground to cover between what was lost since peak activity hit in 2014.
Unmute. Let me turn to you, Vicky, and note that what Cindy said about shareholders wanting their money back is one of the explanations that you get when you ask people, why are we not producing as much oil? Because the shareholders would like some of the profits that they signed up for. Your stock, I looked it up this morning, is up 115% this year. Right now, 63.44 if you haven't looked in the last few minutes. What lesson are you, or what mandate are you getting from your stock price? Is it telling you that shareholders are okay now and you should pump more to take advantage of the price, or pump less to maintain the price? Is there any pressure to expand from, obviously from the Biden administration there is, but from the shareholder side?
We were in a very unique situation in that we did a major acquisition of Anadarko Petroleum and closed that on August 9th of 2019, just 6 months before the price war and then the pandemic hit. So we were in a situation where we took on some leverage to do that. And now when the pandemic hit, we never changed our course of direction. We never changed our strategy. We continued our execution as we were going, but we have what's driven our stock price is the fact that we've paid a lot of that leverage back. We've paid now almost 20 billion of the 21.5 billion that we raised. So that's where a lot of our funds have gone. The rest of it now will go to a combination of share repurchases, because we did issue some shares to buy Anadarko. So we'll do share repurchases in addition to continued debt reduction, and we'll continue to grow our dividend. So our situation is a little bit unique, and that's why our stock price is up to where it is. But as Cindy was saying, we were just coming out of a downturn shortly before the pandemic occurred, because if you look way back at 2016, oil prices fell to $26 a barrel. So the industry had already gone through a downturn and came out of that downturn at the end of 2017, going into 2018. And before sufficient returns could be delivered to the investors, then the pandemic hit. And as Cindy was saying, we have to make up ground now. We have to return value to our shareholders. All of our investors in our stock want us to buy back shares, and they want us to increase the dividend. They don't want growth right now. And although we'll be growing between now and the end of the year, I do believe that the U.S. will not achieve the more than 13 million barrels a day that we were producing in the near future. It's going to take a while to get back to that level because of this demand by the investors, and it's very warranted. Our investors deserve to get some benefit now of where prices are, and so that's what we're ensuring that we can do. And it's not just a return of capital, it's return on capital, because now with the discipline, with the fact that the technology did drive down our cost, we're now in a position to do both. And I think our industry will earn the respect of the investment community back with this discipline that we have now. It's just very difficult that it came at a time that it did, with all of the factors that have hit our industry, that have hit the world. And there still remains a lot of uncertainty around what's going to happen with the economy, with the Fed's raising rates, what's going to happen with the China shutdown due to COVID, what's next in the war, Putin's war, what's he going to do next? And then you have the threat of different COVID variants. So there is a lot of uncertainty still in our industry, and that's what's causing some of us to be very, very cautious about growing production too much. We want to preserve cash. We definitely want to get ourselves into a position where we can deal with the next black swan that we see.
If I could quickly follow up, as an economist and business reporter, I understand what you're saying about the shareholders, but I did read in the paper the other day somebody saying, yes, that makes sense in ordinary times, but there's a war on, and the American people are suffering. So is it a little weird, I guess, would be the question, that shareholders are maintaining that position given the geopolitical situation?
Well, I think shareholders understand that there's difficulty now to increase production too. If you don't already have plans in place for and have gotten the materials lined up for your plans, you can't increase activity levels right now. For example, we laid out what we're going to do months ago. 7 or 8 months ago, we were laying out what our activity would be for this year, and we had levels of activity that we were willing to commit to. And again, we're increasing activity. We are growing production from here to the end of the year, but we can't go any faster or any more aggressively than what we're doing today because the materials would not be there. And to compete with others for materials means your costs then get driven up, and then you lose your economic metrics and your returns to your shareholders. So it's not a matter of whether or not we can do the patriotic thing. It's we want to do that. We're just restricted in our ability to do that right now. And I can tell you that the rhetoric from the administration does not help this situation. Because right now, what Secretary Granholm said the other day was absolutely right. She made the comment that the lack of the federal government offering more federal leases, that's not the cause of where we are right now. That impact comes 3 to 5 years down the road. But the impact right now is when you create an atmosphere that in a implied position that you don't want the oil and gas industry in the United States to ever grow again. When you create that perception, it drives what others do. For example, some of the agencies are going beyond their authority and outside their authority to do things that are restricting our ability to grow our infrastructure and to be able to grow our oil and gas production into the future. That is a problem for the United States. You know, I could see us being in the same situation that Europe is in down the road if we don't have a change in how people view our industry. And I can say I very much applaud President Biden and where he's headed with respect to his desires around climate mitigation. But this notion that the only way to achieve emission reduction and the only way to protect the environment is to limit oil and gas production and or reduce it, that's a false narrative. That is absolutely not true. We have the ability in our industry to produce oil that is carbon neutral, and we need that support, and we need the ability to continue to do that. And so we do need support from the government. We need support from all the regulatory agencies. We need support from FERC. There's a lot of things that we could do in this country. We have the resources, we have the capability. We, up to this point, had the infrastructure to do what we needed to do. And we can continue to be energy independent if we get the support of the administration, of the American people, and the investment community. And I think we have the investment community. It's a matter of ensuring that the right message is being delivered, and that should be one of support for our industry. Because I agree, we need renewables. We need wind and solar, and we need oil and gas. And we're going to need oil and gas for decades to come.
Brian, let me bring you into this with partly a question from the audience and partly a question I was going to ask that sort of parallels that. As a regulated utility, you can pass along excess costs for producing your electricity. How much do you think that's going to amount to? What are the power providers telling you about where they think things are going to be going? The question from the audience is, do you have an idea of the net loss of energy due to the closure of coal plants in the past couple of years? So from a utility point of view, how do you see these things?
So a good couple questions is I think about the natural gas cost increases on the electric utility. It's relatively minor. For us, it's $1 increase in the price of natural gas is very low single-digit impact on our customers. And that's really because we have a diversified generation fleet. In Minnesota, we have nuclear. We're one of the largest wind providers in the country. We moved very fast about 5 years ago to really build up our wind fleet. Now, we estimate that we're going to save our customers about $1 billion in avoided natural gas fuel costs because of our own wind fleet this year. So really having that diversified fleet, and we do have coal units online still. We'll be completely out of coal right now by 2034, completely out of coal in Minnesota by 2030. And so we'll start to shut down the coal plants. But it's really about having that diversified fleet of wind, and we're looking to build about 10 gigawatts of renewables over the next decade as we shut down that coal fleet. Now, we will need natural gas. Right, that natural gas is important to turn on. Right, you need something to turn on to ensure your system's reliable. We all saw the very unfortunate events in Winter Storm Uri when you don't have reliable generation. And so, from an electric customer perspective, we certainly view that bill impact as manageable. And while it's certainly you talk about those increases, I think we look back for the past 30 years, the cost of electricity has been much lower than the increase in the median household income. And so as a percentage share of wallet, we're 20% lower than we were in 1990. And so when we look at that as a percentage share of wallet, we're at 2% as an industry from electricity perspective. But on the natural gas, I mentioned this earlier, on the natural gas LDC, our customers do feel that increase in gas commodity costs, just because it's about half of a customer's bill is the pure cost of natural gas. And so when we see an increase in $1, $2, $3, $4, our customers feel that, particularly the low income customers. So continued federal assistance from our low income home energy assistance program is really important as we work through this, because you do have on the natural gas LDC side, you have fewer levers in terms of you don't have offsets because we're essentially takers of that natural gas commodity cost. So I think longer term, certainly our states, at least in Minnesota and Colorado, working on beneficial electrification plans as we align our natural gas LDC and the climate science and moving towards net zero by 2050. But I think in the near term, it's something that we are working with and we'll work with our regulators closely with, is how do we mitigate some of those cost impacts.
As the head of the technology and innovation group, let me follow up with you, Brian, and ask, you mentioned nuclear. And for people who grew up with 3 Mile Island and Chernobyl, I was reading the other day, or somebody was actually telling me the other day, that Americans and people around the world have no idea how much different nuclear reactors are today and how much safer they are, and that we really should be looking at that. But I just wonder, given the political situation, do you think that will ever come back as a major provider of power?
There's a couple aspects to that. One is there's been a couple large-scale nuclear plants that have been, one is under construction by a peer utility, and the cost of that nuclear unit has escalated significantly, and you can't, a publicly owned utility couldn't take that type of financial bet for how long it takes to build new large-scale nuclear. We personally think nuclear, we as a company think nuclear is a very important part of the future. We just got one of our nuclear units extended in Minnesota to another 10 years. So we're looking at 70 years. But what we're looking at, and we have a memorandum of understanding with NuScale, is the advanced nuclear, the small modular reactors, which are still a ways away. But Bill Gates is one of the largest investors in NuScale. And so we're looking at how do you have a reliable carbon-free, what we call base load generation unit in the future, when we know how to get to 80% carbon reduction. We don't yet have the technology available to get to that at an economic price point to get that last 15 to 20% of carbon out of our generation stack. So, I think there's a lot of private money going into the small modular reactors, advanced nuclear, but we also do need some federal support from the NRC, from licensing. And really, ultimately, long term, we do need a federal consolidated storage for our new spent nuclear fuel. So there's a number of different aspects to that, but I think it is an important part of our energy future if we really want to hit the climate goals that the administration wants to.
Cindy, let me come back to you and ask about how soon we could see, if everything worked all right and the shareholders agreed, additional supplies of gas and oil come to market. If short cycle was something like 3 to 9 months before, where would we be now if you could go all out?
Well, I think we'll probably add 1 million barrels a day in short order, probably a year, just with the increase in the rig count that we've seen. I just kind of want to remind everybody, the US is only about 12% of global supply. And so the thought that we can cure all else that quickly, it's not going to happen. And I think Vicki commented on that as she used the word rhetoric in the media. I'd almost say that our country is bipolar on this issue as to whether we want oil and gas or not. And I go to Brian's comment talking natural gas is a huge element in power production. It has led us to the reductions we've seen in greenhouse gas emissions, and yet somehow we want to cut it off or call it a bridging fuel. I say go drill the heck out of natural gas, convert it to LNG, substitute all of the coal plants being built in India and China, and why can't the US lead in this effort? And I'll also say 2 things. Number one, Brian, natural gas subsidized the cost of energy in the past, and the switch to alternatives. The consumer generally paid a flat per kilowatt hour fee, but at the same time, you were investing in higher cost alternatives, but you had the benefit of low natural gas prices. I see Brian shaking his head. And so now, yes, natural gas prices are going up, but it's because we are restricting its development. And a lot of LNG is actually crude oil based. What comes out of Qatar and Australia is not natural gas based. Natural gas has had a price advantage for decades. We're not using it. When we need, I say, go all out on natural gas. It helps with the emissions profile as it is a substitute. And don't think this industry doesn't support alternatives. Vicki has led on this effort. I'm trying in my world to lead in this effort. Texas is the largest producer of wind power out there and has been. We're adopting solar. We're doing these things. And I always say, don't kill an industry before you have a reliable, cost-effective alternative. But this industry I work in, and Vicki works in, and Brian works in, will lead the transition. We will not resist it. We've got the capabilities, the engineering talent, but to Vicki's point, you can't turn on a switch. I think there's a perception that there's all this untapped production that is being held back right now. Not the case. And I wish there's such an easy answer, but the easy answers are allow the US to run unfettered, produce oil and produce natural gas. We can do it quicker, safer, cheaper, and better than just about anyone in the world. And you know, I know a lot of you know I support efforts at the Dallas Fed. I'm on the board there. The first question that came to me was not what we can do in the US. Let's go to Venezuela. Let's figure out if they can fix my problem. And Vicki and I both worked decades in Venezuela. They used to be growing, thriving country, producing nearly 3 million barrels a day. They're at 600,000 barrels a day because of poor leadership in their government through now Maduro. It's just a terrible situation, but we always want to go somewhere else to get what we need. Focus here on the US.
Let me ask you, Vicki, about something that I have been reading about the last couple of days. This has really kind of come up, and I think Jason mentioned it. The only people who really buy physical oil are refiners. What really matters to the country and the economy, distillates, diesel, the backbone of American industry, and the price is soaring. Jet fuel prices are soaring over the past few years. A lot of refineries have closed. Doesn't matter, I guess, if you drill for more oil, if you can't refine it. What's the outlook there? I mean, are we going to have this wedge? Even if you are producing more oil or natural gas, we're going to have this wedge that keeps the price higher.
I don't think that we're going to have refining capacity issues. We proved as a world we can produce 100 million barrels a day. And right now we're probably at around 97 and a half, 98 million barrels a day. So we're not at the capacity of our refining situation. And here in the United States, we do import oil, but it's heavier oil for the refineries that are better equipped to handle heavy oil. So we don't have a refining limitation here with respect to where we've been in the past. So we can get back to 13 million barrels a day. So the problem is not going to be a situation where the refining capacity limits us and what we can do. Now on the product side, one of the issues that we ran in during the pandemic is that we had to restrict oil production because all the storage capacity for the products was building because of that demand destruction. Now we're in an opposite situation in that the products are being moved as quickly as they can be to meet the demands, but prices are still high because of the limited supply of oil.
All right. Well, coming up in just a few minutes, we're going to be talking to a couple of Washington policymakers. And before I let you all go, I want to ask each one of you. I'll start with Brian. You know what they want you to do down in Washington. What is it you think that could be done or that they could do in Washington for the energy producers around the country?
Look, I think the clean energy pieces to the Build Back Better Act are really important to accelerating this transition in the deployment of renewables, solar, wind. There's a nuclear production tax credit in there. Nuclear is a really important part of our carbon-free generation mix right now, and there's pressure on some of the what we call merchant nuclear plants to shut down. And so I think that's one piece, but also part of that bill, that legislation has incentives for domestic manufacturing. Building a clean energy supply chain domestically, I think, is really important. We've seen the impacts recently on the solar supply chain with potential sourcing products and materials from China. So I think that kind of both aspects of that legislation are extremely important for us long term to keep the electricity prices low. We think we can ultimately make this transition at or below inflation, depending on your view of inflation, but pretty low. And I think that would accelerate the transition. Our investors, Vicky talked about investors. Our investors ask us, how can we go faster? That's what they ask us. Can you shut down your coal plants faster? Can you build it out faster? And I think what Washington could do is act on that legislation.
Cindy, what do you think?
For me, in my world, again, manufacturing service, I need increased workers and capital access are probably the primary things for me. And how do you get more workers? The government can't produce those, but possibly just the rhetoric being tapped down. It's hard for new college graduates, 30 years old, to aspire to go into an industry that they're hearing on the news is going to die in 10 years. You mentioned long-term investments like refining capacity. I could say the same thing about a manufacturing plant. If you have a view that you have no terminal value after 10 years, who's going to invest in it? So we need to be more realistic about an long-range energy policy. And actually, like any strategic plan we do, we put the goal in mind, but also the steps that need to get there. And that affects energy transition, timing, and investments and everything else. But through COVID and through all of the ESG initiatives that are out there, our access to capital has dried up. I have to live off my free cash flow. I'm trying to invest in floating offshore wind technology, geothermal technology, deep water mining for rare earth minerals, but I am cash flow constrained. And a lot of people will go fund a SPAC that has no background technology or experience. I've got decades of working offshore, but I need to fund current operations at the same time I'm funding research and development. And I need to accelerate those. I need capital for that. And the government can't answer it, but possibly a longer range plan that proves up the economics of some of these things could help lend support.
A quick follow-up to that, Cindy, is the Fed raising interest rates, and they're talking about 3% to 4% as maybe a terminal rate. Some people saying higher than that. But is that going to make a difference in your planning or your financing, or are you unable to get financing anyway, so you're not worried about it?
Well, right now, we have basically fixed cost financing in place in the form of a convert. We do have a line of credit with our banks, and interest costs would go up. That all comes back to the economics of the project, but we're not as interest rate sensitive as some sectors, just because of operating leverage when business does improve.
All right, Vicky, your thoughts on Washington and how they could actually help the situation?
I think Cindy said it best earlier, but I would just reiterate that we do need the support, the messaging, the support for our industry. I think the United States should be very proud of our industry. We've developed incredible technologies over the years to be able to take advantage of a very vast resource that we have in the United States, and that can continue to fuel our economy for decades to come. We're doing it in the right way now, but we still have advances that we need to make with respect to climate change. And we're now investing in new technologies that will make our climate transition faster than it's been in the past. And we have technologies where we're going to extract CO2 out of the atmosphere. We can use that CO2 to produce our carbon neutral oil. We're also going to continue our efforts to capture CO2 from industry. That anthropogenic CO2 also could be used to make products and or incremental carbon neutral oil. We need the administration to understand what that is and how it works and support it. And I believe that certainly the Department of Energy and Secretary Granholm recognize the importance of this part of it. Even President Biden has recognized the need for carbon capture, use, and sequestration. And we appreciate the fact that he's included that as a part of what he wants to have happen in the United States on a go forward basis. So that support is there. We just need it to be stronger and more consistent with also growing U.S. oil and gas production. As Cindy said, we need to have that happen. We need energy security for the United States. We need to not get ourselves in a situation like Europe is in today. And so I would just request that we have more collaboration and discussions around how to make that happen.
Follow up to that, you mentioned climate change and efforts to mitigate that. How does that affect your ability to bring more energy to market? Does it raise the cost significantly?
No, actually, we have a way of leveraging our 50 years of managing CO2 for enhanced oil recovery. Since we've been doing that so long, we have the infrastructure installed to make that happen in a bigger way in the Permian Basin. So the more CO2 we extract from the air, the more that we capture from industrial sites, the more volume we have. What that means is we can put it in reservoirs in the Permian Basin and generate more production from those reservoirs while sequestering the CO2 that we inject. And what that means is that you can get more reserves and production out of the reservoirs that we have today. For example, in a conventional reservoir with primary production, you get 15%. With water flooding, you get 30%. But if you can put CO2 in an oil reservoir, we've gotten up to 70% of the oil out of those reservoirs. Otherwise, you're leaving a lot of the nation's resources in the ground. In shale, we only recover about 10% of the hydrocarbons in the shale reservoirs. But with CO2 imposed in the shale, we can double that. So with existing infrastructure, meaning a lower carbon footprint, because you're not having to go to new sources of oil and install more infrastructure to develop new areas, but getting more out of what we've already developed today is the lowest carbon way to bring additional production to the United States for a longer period of time. And we're committed to doing that.
Well, we are about out of time and we're committed to move on to the next panel. So we'll do that, which means I don't have time to ask you the last question that I had here. October 8th in Tuscaloosa, the Aggies visit the Tide. And I was going to say who wins, but we just don't have the time for you two to argue about it.
Roll Tide, Cindy.
Giggle Maggie's, Vicky.
All right, we'll get back to you guys in October 9th, and we'll see how it all turned out. We'd like to thank Cindy Taylor, Vicky Hollab, and Brian Van Abel for joining us today here for the energy conference put on by the Minneapolis Fed and the Dallas Fed. Thank you all.
Yeah, thank you, Mike.
Thank you, Mike.
Thanks.
All right, we're going to switch gears now and move to our political panel. We've got two senators with us, bipartisan, one from each side. Senator Kevin Cramer from North Dakota. He was first elected in 2018. Prior to that was the at-large representative for the state of North Dakota. He's a member of the Armed Services, Banking, Housing, Urban Affairs, Environment and Public Works, Budget, and Veteran Affairs committees. He has a very big business card to fit all that on, and he also has a lot of fracking in his area. Senator John Hickenlooper of Colorado also has a lot of fracking and energy in Colorado. He was elected in 2020, was the mayor of Denver from 2003 to 2011, and then governor of Colorado from 2011 to 2019. He's a member of the Commerce, Science, and Transportation Committee, Energy, Natural Resources, Health, Education, Labor and Pensions, and Small Business and Entrepreneurship. So both of them have a real tie to the energy business. Let me ask you both this, and I'm going to start by doing something that I know you'll both hate, because I'm going to bring up the House of Representatives. And as far as senators are concerned, to ask those people over there on the other side of the Capitol. But they're going to vote on a bill banning excessive gasoline prices, price gouging. It may come over to the Senate. Is that a thing? In other words, is the feeling that people have that the energy companies are taking advantage of us, is that something that you think is actually happening? I'll start with Senator Cramer, since you're sitting right next to me on the screen here.
Sure. Thanks, Mike. And great to be with you, and great to be with John. I often I look at John Hickenlooper on the Senate floor, and I think if John and I could just, go out to the side, I think we could fix a lot of things together. Such a good, pragmatic, common sense guy. But I don't think that, Mike. I think that what we are seeing is just natural supply demand challenges. And there's really no incentive to quote, take advantage, I don't think, of this by ramping up prices, because frankly, the prices are now at a point where the inflationary pushback is going to start driving down demand. And one thing I can tell you about producers, oil and gas producers, at least in my state, they like to produce more. I think they'd rather produce more at a reasonable, profitable, consistent price than try to drive up price to a spike. Remember, they're just coming off of a valley. Not that long ago, oil was upside down in North Dakota for a while. They actually had to pay people to take the oil. So no, I don't think that's happening. I think it's a scapegoat. It's an easy target. It happens from time to time, and I actually think the ramifications would be very negative.
Senator Hickenlooper, what do you think in terms of the public reaction to all this? I mentioned earlier at the start of the last panel that the University of Michigan does its consumer sentiment survey every month, and they came out today with part of it showing that 46% of the American people think gas prices are going to be even higher 5 years from now, and 20% say they're going to be at least this level. How much of a problem is it that that's the public feeling?
Well, public sentiment counts for so much. Abraham Lincoln said famously, with public sentiment, nothing can fail. Without it, nothing can succeed. And that's that sensibility that these high prices are going to lag for a while. I hear it everywhere when I go around Colorado, but I don't think it's necessarily accurate. And I agree with Senator Cramer, who is one of the more pragmatic senators in either party, which I admire tremendously. And I think that the supply and demand is, as the people take their foot off the gas pedal because it costs so much to fill their tank, that lack of demand is going to force prices to come down. And I think that you're going to see that globally, not just in the United States.
How soon do you think that's going to happen? And I put that in the context, Senator Cramer, of we know the administration would like to see a lot more oil and gas on the market in the near future. do you think that we get more supply or we get much less demand more quickly?
Yeah, boy, that's a good question. I think you're going to see demand come down, frankly, but remember too, a lot of demand is seasonally driven, and we're just getting into the driving season up here in the Northern Plains and the Midwest, and really throughout the country, obviously, as we're going to the summer season. But on the other hand, we've all gotten pretty good at getting together on our computer screens, and $1,200 round trip airfares, might cause a lot of businesses to say, hey, this online thing worked pretty well. Maybe we don't travel as much. So I don't see supply coming back real fast, just because there are too many negative signals being sent, and a lot of them being sent by the administration. I mean, on the one hand, the president wants more oil and gas produced. On the other hand, they're lengthening the time to get permits on federal lands, and lots of other mixed signals. I think we have to get that together, but we also cannot ignore the obvious, and that is that energy has been weaponized in the war in Europe. And there's a lot of demand in Europe that's asking for our help. This is why John and I are working together with our colleagues on both sides of the aisle to recognize and help our policymakers recognize that our allies in Europe they need what we have, and they want what we have. They're willing to build the infrastructure to take what we have, particularly in natural gas, but also in oil. And that if they buy it from us, it has the additional benefit, besides national security, of being cleaner and more climate friendly. So I think we can all meet our goals if we just come together and recognize.
Senator Hickenlooper, you were talking about incentives for the energy companies, and we were just talking with CEOs of some energy companies who say they're under a lot of pressure from their shareholders not to expand right now, to take the price and pay the shareholders back because they went through some down periods and they had no revenues, just not enough, put it that way. And so, I mean, given what Senator Kramer says about the war in Europe and weaponizing energy prices, is it a little weird for shareholders to want to restrain the energy industry in this situation?
Well, they've been disappointed for a number of years. The price of oil, most recently went down below $50 a barrel in 2014. And from then on, 2015 on, oil and gas really delivered pretty abysmal returns. Even the recovery after 2016 the prices had begun to come back down. So I think part of this is that the inexpensive gas has been found. The inexpensive gas or oil has been found. I'm a recovering geologist, and we always used to say geology beats technology in the final tally. As important as directional drilling and hydraulic fracturing were in driving the shale gas boom, it still is controlled by the geology that we're dealing with. And I think the oil and gas is in a tough situation. They need long-term infrastructure, and yet we can see that the climate change is real, and that this is going to be there's a sense of urgency around this transition. What we're really lacking is a plan, a long-term plan, so we can have some guardrails on what the price of oil is going to be, so that the industry can have some way to recognize and plan for what their markets, or how markets are going to evolve. And as Senator Kramer said, looking at some way of taking the fact that the U.S. oil and gas is far cleaner than pretty much any oil and gas produced anywhere else in the world. And therefore, if there was some sort of border adjustment that allowed us to deliver that oil and gas to Europe, to Germany, to Ukraine in an advantageous way, we're making maximum advantage of our resources in the short term, and really helping our allies, the people we are standing beside and will stand beside, helping them in their time of need.
Boy, if I could just expand on it, because John he raised a great point. The geopolitics of the moment present the opportunity, I believe, for the moment, if we just recognize certain things. We have a I'll call it a 2050 aspiration. Nothing wrong with that. We have a 2022 reality, and the urgency of the two are sort of clashing, and the lack of a plan, the lack of a short-term, mid-term, and long-term plan that investors and innovators can count on really is a problem. And I don't expect the government has to necessarily draft a plan, but but we ought to at least recognize certain realities. And sometimes we let politics get in the way of those realities. I'm more than happy to help my friends Sheldon Whitehouse and Tom Carper reach their 2050 aspirational goals, as long as that we don't destroy the economy in the process of getting there. And that's where John and I completely agree. And I also appreciate his reference to the geopolitics and the border adjustment, because he and I have been working on an idea that would recognize that there are those of us that do this cleaner than others. And a lot of them are European allies, the United States, when it comes to producing, not just producing the energy, but obviously producing the energy that goes into the production of everything else, whether it's food, manufacturing, even technology, and have a standard that if you don't meet our standard, you're going to, there's going to be a tariff on your imports into our country. Now, we're not talking, mind you, about a carbon price, a domestic carbon price. I think that's politically not tenable right now. But I do think that a standard that is used as a trade tool that recognizes how good we are at production could be a very useful tool and build some really good alliances, trade alliances, that have otherwise eluded us, frankly.
So the question I would have, Senator Hickenlooper, is that most of the people from whom we import oil are not necessarily aligned with American values. Shall we put it that way? And so would that really actually help?
Well, they certainly aren't aligned with our values, and part of that can be attributed to the methods that they use to extract their resources. That's why they are generally filthy in the extraction and processing and refining of oil and gas resources. I think the thing to recognize is that electric vehicles that transition is happening. I mean, I call it the great transition. It's happening on so many different levels simultaneously, and that's why the planning process is it's multivariate. It's very, very complex, but equally important. I mean, tremendously important. But when you go, anybody who's driven an electric vehicle, they're more fun to drive. They're more efficient. They don't break down as much. They're much cheaper to operate. Once the prices come down as they scale the manufacturer, this could happen relatively quickly. It's hard to predict how fast a change like this takes place. And I obviously understand that there are supply chain issues around battery components. I mean, go down the list. There's all kinds of things that have to be included in a comprehensive plan. But this is a fast transition. And that even as we use border adjustments or whatever tools we can to try and help Europe get through this difficult period, we've got to not take our eye off the ball, as that climate change is real, and we are going to be consistently addressing it in pretty much every plan we make.
You make a good point, one that sort of my boss has talked about quite a bit. Michael Bloomberg noted that no matter what the arguments in Washington are, the cities and states have been proceeding with climate change mitigation, and a lot has been done, and it can be done. And I'm wondering, Senator Kramer, when Washington joins that, is climate change at this point too divisive to have a federal guiding hand?
Oh, I don't think so, but I think the guiding hand, the marketplace sort of creates the guiding hand. And if the government doesn't screw it up, I think you're going to see a transition that happens organically. I mean, listen, we've reduced emissions in the United States during the same time frame as we became the #1 producer of oil and gas in the world, at a time when our competitors have not, particularly the big polluters like China and India. So part of it is recognizing that we do it pretty well. Now we need to continue to do it well. We need to get better at it, and we are getting better. In fact, your previous panel, I was fascinated listening to Vicki. I mean, we have a new pipeline that Denbury has built from Wyoming and Montana into North Dakota, taking carbon that's been captured in their energy production and now being used for tertiary oil recovery, which will, when it's ultimately working, will create carbon negative oil. And so everybody sort of gets to have their goals if we innovate and we allow the innovations to take place. This is why I think we should be more fuel neutral in our aspirations and just focus on emissions. If emissions are the goal, to reduce emissions is the goal, let's set that goal and provide the incentives that turn the innovators loose on that. So I think we can do it. But there's nothing wrong with states and localities doing it either. But remembering that not every state, not every locality is the same either. Electric vehicles work better in Denver than they do, out in Western North Dakota, for example. But I share John's enthusiasm. I think this transition is happening to a great degree. But the value chain, the supply chain, remember, to build batteries, you have a mining supply chain. And so, we got to get back to permitting reforms.
As I understand it, lithium, the main ingredient in those batteries, is hard to get because of the war. Senator Hickenlooper, let me go back a little bit to what you were saying about getting other countries to follow our standards. There is a bill before the Senate now, the NOPEC bill, that would prohibit dealing with cartels. Does that sort of fit in the same category as the price gouging measure over in the House of it enables us to register our complaints without actually solving the problem?
Well, I wouldn't go quite that far, but I do think it's interesting to recognize that if you look at the United States and Canada, and really if we were able to provide some environmental support to Mexico, we have in North America an energy critical mass, let's say. And it's not just oil and gas, but it's wind, it's solar, it's all these things. If we worked on a more regional basis, we would have a profound effect on the cartels, and they would not have that stranglehold that they currently have. And from my point of view, I look at, as we do this great transition, we don't want the cost to be largely on the backs of working people that are struggling to make their monthly budget. And as gasoline prices go up, suddenly they're in the red at the end of the month. We've got to figure out a better way to, have this transition a little smoother, especially for those people that are making less money each year.
Yeah, interesting point. And I agree with John. I think we could have a North American energy alliance that would, be superior to any in the world. And we do it cleaner. We also, back to that values issue you mentioned earlier, that's part of this geopolitical movement. There are other values like humanitarian values and labor standards, things that, again, we shouldn't have to apologize for, but we also shouldn't be punished for. And boy, I couldn't agree more. In fact, if we do this again in 6 months or a year from now, we should get Jason Kenney or one of the premiers from Canada to be part of it as well.
There's a good idea. The American people don't buy oil. The American people buy gasoline or diesel, or they pay for their jet fuel and airline ticket prices. And distillates are a huge problem right now. Refining capacity is tough, and we're seeing shortages in all these areas. Particularly diesel worries a lot of people. It's sort of the backbone of American industry. Is there anything, Senator Hickenlooper, that's going on up on Capitol Hill that would alleviate that problem?
Well, there's a lot of investments going into, the bipartisan infrastructure bill that Senator Kramer and I both, I think, I don't want to misquote Senator Kramer. I'm pretty sure you were part of that resolution of the one issue. Anyway, that bipartisan infrastructure bill has a lot of things in it that, as we are able to make those investments, will help limit the inflationary costs we've seen. But I always am fond of saying, if you want to look at the most deflationary energy sources, it is the renewables. It's wind, it's energy. As we went through this inflationary period, people getting more of their power from wind and solar have seen no stress at all. It's really the more volatile parts of our energy mix, which rightfully or wrongly are tied to more traditional energy sources.
Senator Kramer, is there anything that you think should be done to ease the ability of refiners to produce?
Well, I do. I think that we are so highly regulated and over-regulated in this country, and there's multiple layers of regulation attached to every part of the value chain, and you have multiple agencies that work not simultaneously, but rather, and certainly not collaboratively, but in a way that extends the permitting process for whether it's a refinery or a pipeline, the drilling itself. that's unnecessary. It's duplicative. It doesn't really enhance the environmental footprint other than slowing down the investment or driving it somewhere else. So yeah, I think as we work in a bipartisan way, and we're talking about things like whether it's fertilizer in Canada, by the way, you talk about, again, North America, because of their natural gas and large mines up there, they are a great fertilizer supplier. So right now we're dependent largely on Russia. I think we can do some things in the permitting and certifying some of these projects, but then also litigation. One thing about a lot of regulation is it makes room for a lot of litigation, and regulations and litigations oftentimes become the barrier to entry or investment. And so absolutely, there's an area. I think that's the area where we ought to focus. It's not so much about what the government can do as much as what the government can resist doing.
So raise the price of gasoline on lawyers is the is the solution. I'm wondering, Senator Hickenlooper, about Senator Kramer mentioned the pipelines, and obviously there was a big pipeline controversy at the beginning of the Biden administration. Is it that pipeline, or are all pipelines looked at as dangerous? Because one of the issues that's going to come up with exporting more LNG is getting more pipelines to bring the natural gas to wherever they build the LNG plants.
Well, and your earlier guest talked about having opportunities to put natural gas back into the ground permanently, to sequester it permanently. That's going to require pipelines. Hydrogen, which has enormous potential to be a big part of our, of our storage solutions for electrical energy. That also is going to be built upon a pipeline system that, again, we've got to look at how can we make it easier while still protecting the local property owners' rights and not trampling any state or county authority. We have to figure out ways to simplify not just pipelines but transmission lines. If you really look at, people are very optimistic that we're going to be able to immediately build all these transmission lines that will allow us to efficiently harvest the renewable energy that's sprouting up all around us. But if we can't get those transmission lines permitted, we're suddenly going to find we have gaps in where we're producing energy and where we need energy.
Senator Kramer, NIMBY seems to be a major issue around the country. How can that be addressed?
Yeah, it's a really important point. I was a regulator for nearly 10 years, and I cited lots of pipelines. I cited the original Keystone Pipeline, carried the pipeline portfolio on the North Dakota Public Service Commission, lots of transmission lines. We built several thousand, megawatts of wind power in North Dakota because we're windy as well as full of coal and oil and gas. And we didn't have that problem much here. Is when you cross state lines, particularly going into Minnesota, where things became very difficult. And it's gotten much, much worse, somewhat because people are legitimately concerned about infrastructure crossing their property, in other cases because they see it as a way to stop whether it's fossil fuels or the movement of clean energy even. And I think that the trick here, and this is where a former governor comes in really handy, so Governor Hickenlooper can help us with this, and that is finding that right mix of a federal backstop, but maintaining local control. And as you know, not all infrastructure is created equal. Transmission lines for electricity are different than, say, an interstate oil pipeline, which is sited at the state level, but a gas line is FERC, under FERC jurisdiction. I think we can simplify a lot of that, bring more order to it, work on more corridors so you don't have to have multiple corridors all over the place, and just try to bring some order to it. Not a small matter, however.
All right, here's the part where I may get into trouble. Neil Kashkari's son is watching this with his father. And so I want to ask you both about the Federal Reserve and its role here. Obviously, they're going to be working on demand destruction to try to bring some prices down. But first, the Fed has spent time and is going to be spending time trying to assess the impact of climate change on the economy and whether or not the nation's financial system is robust enough to deal with things like Miami being underwater or something like that. Senator Hickenlooper, we'll start with you. Do you think that there is a role for them in that, or do you agree with some of the folks on Senator Kramer's side that it's not the Fed's mandate?
Well, I think the Fed's got to be part of the analysis that allows us to begin to assess what are the costs going to be and how are we going to pay them. A lot of people have diminished the threat of climate change. It's overstated. It's not going to be that serious. And we used to have a fire season in Colorado where we would begin to see fires maybe in late May, June. They go through July, August, into September, maybe. Worse. So no, it's Mexico right now going.
We're having some trouble hearing you,
issues
Senator.
around Florida changes. Sorry, well, I'll turn it back to Senator Kramer.
I'll
I'm
let
sorry.
Senator Kramer jump in, and maybe
I'll
we
beat
can
this
fix
thing.
your audio while he's offering his thoughts.
So, no, I think the Fed should stay in its lane. There are lots of agencies that have lots of responsibilities. The problem is climate is not the responsibility of every agency. And the Federal Reserve, in my view, and this won't surprise Neil at all, in my view, they have twice as many, mandates as they need. I think if you keep the cost of money, you keep inflation under control, you're going to make a massive contribution to the economy. It's no secret to anybody that I think that the Fed moved way too slowly. They know that now, but I was talking about it a couple of years ago, with Chair Powell. I'm glad Chair Powell finally got across the finish line yesterday in the United States Senate, and we have that certainty for us. But these are the things, Mike, that lead to the chilling messages that come from a government where the SEC is now very, very aggressive in demanding climate data. They don't even have that authority, and yet they do it. The Federal Reserve, of course, the comptroller of the currency, you name it, CFPB, everybody's in the climate game now. And the reality is when you measure that, and John uses a good example, and this is one that Secretary Yellen often uses. You have to be concerned about fires in the forest. Okay, but is that a climate issue or is that a fire insurance issue? Is that a forest management issue? That's obviously a situation or a circumstance that requires risk assessment. But at the end of the day, demanding climate risk analysis is not the same thing as demanding location risk analysis. And it just gets into the same morass when it all becomes part of this broad sort of climate movement. So anyway, there are plenty of things to be concerned about, but the regulators, in my view, need to stay in their lane and do what they do best. At the end of the day, it'll all work out. I really believe that.
Senator Hickenlooper, I think we have you back. Did you want to finish your thought?
No, I mean, I think Senator Kramer covered it well. I would differ with him slightly on the assessment process, that I think in some of these places where you have a number of different locations all facing similar issues, that the Fed could play a role. I'm not saying they're going to be the absolute authority, but that is something traditionally the Federal Reserve has taken some responsibility for.
Well, I'd like to thank you both for joining us today, Senator Kevin Kramer from North Dakota, Senator John Hickenlooper from Denver, and we hope that Russell Wilson will bring much happiness to the Denver Broncos this year, Senator.
Me too.
All right, thank you both, and we thank everybody for joining us so far for the Energy and Inflation Drivers and Solutions Conference from the Minneapolis Fed and the Dallas Fed. And I will turn it over now back to our leader for today. I think that's Tecumseh Kashkari.
Thank you. It's great to be with you, and thank you for a great job hosting, Mike. Yeah, Tecumseh's ready for a nap, so I'm going to get ready to take him home and put him down for his nap. But thanks everybody to the great conference, my colleagues at the Dallas Fed and the Minneapolis Fed, and all of the excellent experts, including the two senators who really brought very thoughtful insights. As I started, inflation is much too high. Energy is a big part of that. And we at the Federal Reserve need to bring inflation down, and we will bring inflation down. I'm confident of that. I'll tell you what I heard today from the experts is that it doesn't appear that there are any short-term fixes to bring energy prices back down on their own on the supply side. which means we'll probably have to carry more of the load through monetary policy in bringing demand down. But we are going to keep looking at the data, keep assessing what happens on supply, what happens on demand, what happens on workforce, and try to make the best decisions we can. So thank you all for joining us. Thanks for our great experts who shared their insights, and I hope you all have a great rest of your Friday and a great weekend. Thank you. Say bye. Can you say bye? Can you blow a kiss? Not so much. Bye, everybody.